Hey guys, it's Amon
And Christina
from Our Rich Journey. You know, something is going on in the stock market right now that makes absolutely no sense. We are sitting here wondering, why hasn't the stock market crashed in 2023? Because 2023 has been a year full of disasters, wars, economic collapses of all types, strikes. There are so many things that are going on in the world and in the economy that there is no reason why the stock market should be up at all in 2023. And so in this video, we want to have a conversation about why that's the case. Why hasn't the stock market crashed in 2023? And maybe if it hasn't crashed in 2023, are we building up for a huge crash in 2024?
So we do not want to gloss over all of the happenings of 2023. There has been a lot that's going on that could really indicate to people that a crash is about to happen, that a crash should have happened, that we should not be up year to date in the stock market like we are. So let's go into detail a little bit about some of the things that have happened, which would typically indicate that a crash should be happening right now. So first, let's start with some obvious things. And I think the first thing that's big that's impacting everyone is high interest rates.
Oh my goodness. Interest rates at the beginning of this year, they were high. But as we have gone on throughout the year, they've gotten a lot more higher. And in fact, interest rates on home loans are at 20-year highs. So interest rates alone should be a huge drag on the stock market. And see, the challenge for investors is that when interest rates are this high, that means you can put your money in a high yield savings account, in a CD, you can put it in a safe place and get a great return. So where's the motivation to want to invest in the stock market?
So that's the thing. When you see these high interest rates, people either tend to pull their money from the stock market, or maybe money that they have sitting aside, they're not putting it in the stock market. Instead, they're investing in safer types of investments like bonds and CDs.
Now, the next thing with interest rates is that interest rates are a drag on the economy. They should be slowing down growth and productivity. But recently, we just got a read on GDP, and it showed that in the third quarter, GDP was up almost 5%, which is counterintuitive. GDP should be down. I mean, all of last year and a good part of this year, they were talking about a recession. But it looks like we are so far from a recession. In fact, we are booming.
Okay, another big thing in 2023 were the bank failures. The bank failures, the government's coming in and trying to fix this problem. And at one point, people really were thinking that this is going to be contagious. More banks are going to fail, the economy can collapse, and the market will crash. As we know now, that did not happen.
I mean, to me, when that banking crisis was going on, it felt like Lehman Brothers, right? It felt like 2008, 2009, and people were considering doing bank runs like they were doing in certain parts of Europe. So to me, what was happening with the banks, that alone should have dragged the stock market down. The chaos, the scarcity, you saw the feds and the federal government coming in and trying to instill confidence in people. But still, that idea of banks failing week after week after week, that should have caused catastrophe in the stock market.
So next we have political issues. We've had this period of time where we didn't know if there was going to be a government shutdown, if the parties could agree on a budget. They did agree on a budget. There was no shutdown, but shortly after that, the Speaker of the House gets ousted by his own party. So there's a lot of uncertainty with politics going on right now and how that can play a role in the response to how the stock market behaves.
Politics is one of those things that the stock market hates uncertainty. And there has been so much political uncertainty with the US government over this past year. The shutdowns, the changing of leadership in the Republican Party. But the bigger political issue are what's going on in the Middle East and the wars that are taking place in other parts of the world. You know, this has been one of those years that we have been bombarded with so much political information that we should be terrified right now of what this could potentially lead to.
Okay, and next we have some issues that still remain unresolved with striking workers. So we have hospital workers that are striking, we have the Actors Guild, auto worker unions, the Writers Guild just finally came up with an agreement, but they were striking for a long time too. And these things can also impact how the economy behaves.
Okay, so the strikes have been really fascinating to me because when you look at these companies, the companies over the past 2 or 3 years have been making gobs of money, while at the same time their employees have not been seeing those same profits play out in their paychecks. And so you are starting to see this movement of employees coming to their employers and saying, you know what? We want some of that profit too. So you are seeing strike after strike after strike. Now, as an investor, if you are looking at the financials of these companies, you start to question whether or not they can meet the demands of their striking employees and how that's going to balance out in the profit and losses of these companies. I mean, when you are talking about investing in the stock market, we always talk about looking at the financials of the market. And these types of strikes, they affect those financials. Now, in my opinion, I'm siding with the employees. I think they deserve the raises. Those profits should be shared because those employees have contributed to the growth. But these are still things that cause the stock market to be a scary place to be in right now. And the final piece that is, I think, a red flag in the economy right now is that you can start to see consumers under a little more stress because of the higher interest rates. You are seeing an increase in auto loan defaults. You are seeing more and more people late on their credit card payments. All of these things that are affecting the consumer, the everyday person is what the stock market is really driven off of, how they consume things. And from my perspective, I am seeing more Americans, more consumers under economic stress. And so it doesn't really jive to me that these companies should have such good prospects for growth to justify their stock prices going up.
So these are all red flags that when people see these things happening, they think that there's going to be a crash in the market. And we are not even finished with 2023 yet. So there's more things that can happen. But so far, we have seen that year to date, this stock market is still up. We have not seen the crash that people would typically expect. So let's talk about some of the reasons why we're not seeing that crash and talking about maybe some of the developments in 2023 that support continued growth in the stock market. And I think one of the things that is unique to 2023, or sort of maybe started in 2022, but built up even more this year, is the use and increased development of AI.
Ooh, AI. I'm glad you brought that up because it seems like AI has really driven the stock market's growth over this past year. I remember at the start of this year when ChatGPT was the buzz and every tech company was talking about how they were going to incorporate AI in some facet of their company. Those tech companies saw the greatest growth over this past year. And really, it has been those tech companies that have driven most of the stock market's returns. And so some of those other companies that aren't doing as well, I mean, there are a ton of consumer companies, real estate companies, medical companies that have not done well at all this year, but it is because of AI and the prospects of that have driven the stock market growth.
So it's really this impact of the tech sector and how they're responding to new developments for AI in terms of the products that they produce, in terms of the services that they can provide because of AI, and because the tech sector makes up such a large portion of the overall stock market, that can be what's really driving the performance of the stock market as we see it. But I think there is some caution with this, because when you just see the performance of one specific sector doing really well, that can have a flip side if something bad happens in this tech sector. So if companies are putting billions and billions of dollars into the development of AI or different types of AI resources or services, and those things don't pan out, and these companies go bankrupt or they have really bad returns over a particular year, that can really negatively impact the stock market. So just as we're seeing this positive growth because of the tech sector, you can also see it really backfire.
The next thing that I think is also keeping the stock market buoyant is the fact that it feels like the Fed is going to stop raising interest rates in the near future because of what's taking place with inflation, and inflation coming back down to the target that the Federal Reserve wants to see inflation at. So with that in mind, sometimes investors can look to the future and the prospects of lower interest rates on the horizon as a reason to stay invested in the stock market. The next reason the stock market hasn't crashed yet is that investors aren't taking the federal government very seriously when it comes to the politics. I'm just going to say it. This happens all the time with the US government. They talk about a shutdown. There's all this turmoil. There's all this drama. It's like having a family member that shows up at Christmas talking all crazy, but you know they're not going to do anything. I hope that analogy made sense. For some of you guys, you know what I'm talking about. But the idea is that the federal government is always a chaotic place. There's always turmoil. So you can't base your investments off of what they are doing.
Yeah, I think that's really interesting because a lot of the times during these impending potential government shutdowns, you see it splashed across the news. That's all everyone is really talking about. Is there going to be a shutdown? Is there not? Are they going to reach an agreement? But I think at the end of the day, we see this repeatedly, these potential government shutdowns, and more times than not, of course, there is no shutdown. They come out with either an extension or a last-minute agreement on the budget. So another big potential reason as to why we haven't seen a crash in the market is also the labor market. Unemployment in the United States is down right now.
And this is a great thing when it comes to the stock market. With unemployment at this low level, there is some optimism that the consumer is still very strong, that the consumer is very resilient, and companies can make projections off of this type of information that is more optimistic. The next thing to be optimistic about in the stock market are the fact that these strikes, there's a light at the end of the tunnel for most of these situations. There's going to be a compromise that's made, and that compromise is really going to benefit everybody that's involved. So for example, if a striking employee is asking for a 25% raise and they get 15 or 20, they're going to use that raise to spend in the economy. It's a cyclical thing. So when people hear about these strikes, it's not something that deters them from investing in the stock market. It's just a reminder of how the economy works, how the free market works. So with all that said, I think there is a huge lesson to be learned about how the stock market has been performing in light of all of these things. You know, if you look at the history of the stock market, chaos has been happening throughout the history of the stock market. There have been all types of things that have created economic and political turmoil that you would think if you looked at it in that one moment, it would hurt the stock market. And it does in that moment. But over the long term, the stock market has always gone up because the stock market is a very resilient place. It adjusts based off of the market. And so when you are investing in the stock market, should there be dips, the idea is that you take advantage of those dips because you know it will rebound. The other thing is you don't know what's going to happen with the stock market in the short term. You don't know how these political, economic things that are happening this particular year are going to really play out when it comes to the price of the stock market. So the best thing to do is to have a plan in place that calls for you to be consistent in how you invest in the stock market. And so the bottom line is that it's not about timing the stock market, it's about time in the stock market. And those people that are long-term investors, they will reap the benefit of building wealth.
So we encourage you, whether you're a new investor or a seasoned investor, don't get too hung up on these red flags or these growth opportunities. If you are consistent with your investment, that is really important versus trying to time the market. So we hope that we gave you food for thought on this video, some things to think about as you are building your portfolio and as you continue to develop your portfolio. So if you like this video, make sure you give us a thumbs up, subscribe to our channel, and join the journey.